Welcome to the Startup Grind.
So I wanted to kind of talk a little bit more about your background. If you can, I know that you were born in France.
Yeah.
And
You don't hold that against me, right?
what's that?
You don't hold that against me.
Okay, no. I love French fries. I mean, you immigrated here about 12 years ago.
Yep.
So why don't you kind of, tell us like how, being born and raised in a different culture, how did that give you an edge in early stage VC investing?
Besides having to repeat myself often, or being subtitled on Bravo, no, I think my background is actually kind of unusual because besides being born in France, I actually studied on the technical side, so I'm more of a CTO type by background, and I did a master's in computer science, minor in distributed computing, got into a finance startup, and ended up moving to the Valley to become a VC when I was 33. And I had never planned to move to the Valley. I had never planned to be a VC, but I really wanted to move to the Valley. And so serendipity got me into the venture world for 4 years as a traditional VC. And then in 2003, when I saw this emergence of Web 2.0 companies that were tremendously capital efficient and suddenly didn't require $5 million to figure out whether they had anything, I thought this is the future. This is what I'm going to go spend my time and my money sort of doing. And I just did it.
This was when you were 33.
And that was 2003. Yeah.
Wow.
And I was, at that time, 36. I'm 46 now.
He said 46.
And the whole point, I think, isn't so much whether I was the ultimate outsider. I hadn't done a startup in the Valley. I wasn't from Stanford or Harvard. But the point is that there was an opportunity. And the beauty of the Valley is that, if you have an interesting idea and the passion for it, no one's going to try and put roadblocks in front of you. People are just going to let you do your thing. And that's what happened. And ultimately, timing was actually the thing that worked for me because at the time, I didn't really have the network or people wouldn't sort of seek me out for money, but I was one of the few who was actually happy to write a check and try and help the companies.
No, that's wonderful because now that you've invested in so many of these startups, I know that this is actually the next question. There's a rule of thumb of investing that you have. Mm-hmm. There's a famous like infographics that's kind of like went viral on the internet. Have you seen that? It has a little lovely picture of your face. And wait, hold on, I got to prep the audience for this. But it says it basically goes like smart donkey, right? Kick donkey, big donkey. And so the first thing I was thinking is like smart to kick a big donkey, right? And the second thing is I hope there's no like farmer in the Midwest that try to do this. So why don't you explain the three S's rule? So
people often ask us to explain what it takes for us to actually make a positive investment decision. And 3-4 years ago, I was with my good friend Rob Hayes, and someone asked the question, and he said, it's simple. I want a smart-ass team in a big-ass market. And I was sort of thinking about that, and the quote at the time was, well, being French, I need another ass. Sorry. And that's how, well, I'm actually an American citizen now. But it came out of a smart-ass team building, a kick-ass team building smart-ass team building a kick-ass product in a big-ass market. I should know the rule. And those are the three components that we really sort of think about: the team, the product, and the market opportunity. And we had some fun defining the 3 S's rule, and recently we had my friend Hugh McLeod do that pretty cool sort of, picture of how you turn the asses into the donkeys, and we have, the small-ass donkey, the kick-ass donkey, and the big-ass donkey. And we put that on our website and the back of our business cards. And it's kind of for fun, but that's really sort of the way we think about filtering opportunities that come through the funnel.
No, it's brilliant because it's like it gets right to the point and people can remember it. So So let's talk about like, so the first role, it's like, what is a great team? What does a great team look like? Like, does a founder, must they have an exit before, like multi-million-dollar exit? I mean, do I need to be a CS major from Carnegie Mellon, Stanford, MIT,
That helps.
Technically? Like, what does a great team look like in your opinion?
So it's always, we talk about a generic team and every startup is different. And so, we've done everything from the solo founder, Aaron Patzer at Mint was a solo founder and we did fantastically well on it, to, a 4 founding team like the guys at Venture Report where we did also really, really well. We lost a founder, along the way. So what we want to see is sort of that deep passion and that sort of good fit for what you're trying to build. Typically, if you have 2 or 3 founders and you can have, a great technical individual, great coder, great, front-end, back-end, bit of design, good sense of product, and understanding of distribution, if it's a B2C play, or, sales and marketing experience, if it's a B2B one, you will increase your chance of being funded. The experience, well, your experience has to be relevant, but if you look at a lot of our founders, they're first-time founders who just dropped out of school or were just at school, and it doesn't prevent us from feeling that they have what it takes to actually be successful. So we try and keep, the most difficult thing for us is to keep an open mind, not being turned off by something which is sort of too easy. And unfortunately, in our business where we get thousands and thousands of opportunities, thrown at us a year, we have to be able to filter and say no very quickly. The example I gave you when we were chatting is I remember being introduced to this thing called airbed and breakfast. And the pitch at the time was you can get an airbed at someone's house, on the cheap if you go to a conference. And it was like, who calls their company airbed and breakfast? Seriously.
Too many syllables.
Well, turns out it became Airbnb, and by the time I was actually paying attention, it was too late. So the notion of being there and being on the lookout and giving a chance to serendipity is really hard for us because by definition, we're just inundated by opportunities, especially right now.
Cool. So I wanted to, actually, so on that same vein there, like, what would you say the percentage of startups you actually invested in previous winners? Like, if you can break it down in percentages, I mean, can you give us some numbers?
So in terms of, so we've done, let's see, so 132 investments as of yesterday since we funded About.me. We just announced it on TechCrunch. We spun out About.me out of AOL. And we have 3 more we have committed to, which we haven't funded yet. We've had 30 plus exits. We've had 20-ish companies sort of flaming out on us. And flaming out means either outright dead or returning something which is not meaningful. And the rest is pretty much, alive and kicking, having raised $1 point something billion in follow-on, so coming after us. And, it's every day it's a challenge of how we scale and get to success these sort of 80-ish companies which are some which have been around for 6, 7, 8 years and are indeed tens or hundreds of millions of dollars in revenue, and others that are just still stealth and about to come out.
Cool. So on your second rule, you're create a kick-ass product.
Kick-ass product. Yeah.
What are you looking for in an exceptional product? I mean, are there like specific metrics that you look at? There's like the famous Dave McClure, the pirate rule, like R, right? Activation, acquisition, referral, right? I mean, do you guys have something similar like that? I mean, do you like look at DAOs and MAOs and DAOs? I don't know, but I mean, what are the metrics that you find very important?
We look at any sort of the important point is that we actually need to look at whatever data you have available for us in order to make a positive investment decision. It's very hard for us to sort of make a decision on a product which hasn't hit, at least a alpha stage where we have a few, tens or hundreds of users playing with the product. And every time we sort of forget that and we invest pre-launch, typically, we regret it. Worked out for us at Mint, because we invested 14 months before the launch, but it's unfortunately an exception. So we'll look at our own experience with the product. We'll look at what you have learned getting the product in the hands of users. And if it's a B2C product, we'll look at typically the retention. So how many times a day, week, month is the product being used? What sort of potential viral factor could we see, even if it's in closed alpha? If it's a B2B product, it's pretty simple. We look at MRR, meaning at this day and age, when you release a SaaS product, we expect you to be able to show us that you find someone to actually use it and pay for it. And recently, we did a deal in New York, which I can't mention the name of, but it's 2 Australian entrepreneurs who had bootstrapped this company, and when they came to us, they were at 25 grand in MRR, and they've already doubled that after we funded them, and now they're up and running and spending some money in marketing. So we look at, is the product differentiated? Have we seen something which is similar in the market? And unfortunately, you might feel that your startup is unique, but from our vantage point, we just see what's out there in the market and we just see patterns. And this morning, we're just looking at one company in our funnel, and I see the description, and I see the same description for another one. I go, oh, we screwed up. It's the same company. And my partner Charles said, no, it's exactly the same. And we have 2 companies with exactly the same tagline, in the funnel. And I don't know whether they're aware of each other, but we just have this more global view of the opportunity, and we want to make sure that we invest in something which could be crazy, but definitely different.
No, that's interesting, because if you see, do you actually take a look at the other, the other funds and see what they fund? Mm-hmm. And then you'll see the products and you're like, well, let's go find something that looks similar but a little bit. Do you do that a lot, or no?
No, because the other funds are our good friends. If you go back to the genesis of the whole Super Angel Micro VC movement, there was essentially a handful of us around the table. No Bean 38 jokes, thanks. And everyone sort of moved up and became sort of an institutional investor and is investing according to a very specific strategy. And so if you know how to navigate, and as an entrepreneur, you need to know how to navigate this sort of funding chasm where, there is something which looks like a true ventures round, or something like a first round, or something like a SoftTech round, and you want to sort of go in front of the right investor. So we look at what they do. We are in awe of the success of a lot of our friends, and we're really happy for them. Overall, as an ecosystem, we've done extremely well, which is, sort of really reassuring. And, I was chatting with Josh Koppelman, who is really an inspiration for all of us, because he was sort of the first to put together First Round 1, which was the very first micro VC fund. And you look at, his ability to bet on a One Kings Lane, an Uber, Warby Parker, which were not obvious because they were the first category movers. And, at least as far as One Kings Lane and Uber actually said no to them.
Yeah. Actually, we're kind of jumping around here, but one of the questions that I had was who do you? Because what you were saying is that you have internal channels to get to you, right? You have internal channels. So who would you say would be maybe top 3 people that these guys can talk to get to your door?
So
if there is any.
That really sort of relates to the question of how do you get in front of investors, and how do you get through the main door as opposed to the back door. And it's really sort of a referral game. So you need to find someone who will be sitting between you and us, who will be hopefully sending us a very strong signal that we should spend the time to get to know you. And remember, it's in the context of getting thousands and thousands and thousands of those referrals, a year. And so typically, the strongest signal, it's not really sort of the three people, but the strongest signal will be some of our portfolio company founders, because we've been working with them for, years for some of them. And so they know what we're good at, they know what we can actually bring to a company, and they know the kind of company we like to work with. A co-investor, and the more we have co-invested with them, the higher the signal. Josh Koppelman at first round, John Callahan at True will be sort of very, very strong signals for us. And then, the sort of ecosystem. We've worked with, hundreds of angels. We've worked with, a lot of lawyers and so on and so forth. And we'll sort of pay attention as well. But you have to keep in mind that there is a sort of pecking order. And when we're pressed for time, and unfortunately we're always pressed for time, often the attention goes to the strongest signals. And it's unfair, it's not perfect, and I wish it was different, but it's sort of the way we've been doing it.
So that's actually good, because to my next question is, let's talk about like your biggest investment payout in your portfolio, and what did you see in them in the beginning? Did they go through the internal channels, and did you have like a portfolio founder referring? So
define biggest investment payout. It's like per amount or multiple or IRR or.
You went to home pretty happy. You had a really good night's sleep that night. That's what I meant by happy. Well, I mean, Wildfire.
Well, I go home very happy. Yeah, well, Wildfire was
Mint.
I mean, could be Mint, could be Wildfire, could be Userplane, could be. There's depending on the metric, it actually the answer changes. But let's say Wildfire. So I was lucky to work with Victoria and Alain for a couple 3 years on Wildfire. Wildfire was actually so successful that they really didn't need money. They were printing money from day one, and so by the time we managed to invest in them, it was sort of a Series A because they had already made so much revenue. And the funny thing is, I think for almost 18 months, they actually didn't touch the cash that we had invested in, which was a $4 million round with our friends from Summit. And then they raised a round, not because they needed to, but they just needed some kind of a market price to figure out potential acquisitions and so on and so forth, because they were still sitting at a valuation which was like half of their actual revenues or something like that. And when Victoria sent me a text announcing the Google deal, it was 5 weeks after I had lunch with her, and we sit with, at the table, and we have Buddy Media being acquired, we have Involver being acquired, we have, essentially the market's consolidating, which leaves, Wildfire almost the only player that is independent. It's very interesting, very exciting. But, I get this text about her signing this monstrous deal with Google, and my answer is, why the fuck are we saying too early? And she replies with a couple of question marks. I'm like, okay, well, congratulations, but it's still too early. And so I thought they had actually a shot at building a really big independent company, but I completely get the reason why Google was actually a great fit. And let's be clear, we made so much money that I'm actually unfair in the way I answered. But that was sort of the way I really believed they could build a really big independent company. And you will have a chance to listen to my friends Kevin and Julia Hartz later today, the two co-founders of Eventbrite. And I've been very lucky to be involved in this one. And Kevin and Julia have just this view of a very, very long-term, independent Eventbrite, which I'm super stoked to be involved in. And so, whatever the biggest return has been today is nothing compared to what's, about to come.
But your goal is always to try to go IPO and not merge with Google and.
No, look, being sort of the early stage investor, we're really aligned with our founders, and so even though I had this initial reaction of what the fuck, I'm super happy for them because they're such good people that I will always go the way of my founders, and it's been the case through our 30 outcomes, many of which were really early, and you were like, really? We're like selling right now when we're just so, killing it, and we could do some more. But look, if the founder in his gut sort of feels that it's the right time, that's it.
I think we'll open up the floor for Q&A. I can just keep on going with our internet interview questions.
Start with one question. I kind of maybe some commentary about the implications of crowdfunding. What are your thoughts on that?
Sure. So crowdfunding is something that we supported, and we see is basically institutionalizing the friends and family round. So before, when I was sort of an angel, I was doing 25 or 50K in a company on my own. It was very scary to be just the only investor, and that is not something which I can do anymore because of the way we've grown up as an investor. And so someone needs to help the companies and give them the first 100, 200, 300K that they need to get off the ground if they need that funding. And I think that crowdfunding is actually a great source for that. The whole sort of Kickstarter campaigns and so on and so forth is an opportunity to validate demand. So when I see a product that has generated $1, $2, $3 million of pre-orders on Kickstarter, doesn't mean that they're going to be able to produce the damn thing, but at least that there is market demand there. And so it's super useful, and in no way is it sort of competing with us at all.
So given customer development, validated learning, how much do you guys metric that in addition to things like traction and stuff like that? Do you find that to be something that helps you feel more comfortable about a team, or?
It's exactly that. So to us, when we go through the process of due diligence and spend time with founders and try and understand how they think about user acquisition, retention, monetization, and so on and so forth, it's more the process that they've gone through to get to the answers that is important to us more than the actual answers. Because the fact that you got to 8,000 downloads or 15,000 downloads doesn't mean much. What's interesting is the way you actually tried different channel and said, well, we tried Flurry, we tried Facebook, we tried this, we tried that. We've seen that sort of that user acquisition getting to download, but we have a different profile of retention. And we try and understand how you think about things as opposed to just the raw numbers.
Hello, my name's James. We heard earlier from a previous speaker that the biggest driver for the most stupid decisions he's made has been fear. Can we understand as an early stage investor what over the next 12 to 24 months you see as your greatest fear that keeps you awake at night?
So because of the challenges you have in raising a Series A today, where the bar is high and getting higher, we actually need to understand what sort of optimal trajectory our companies should have or will have to sort of clear in order to raise this financing. And so for each and every deal now, we ask ourselves, what is the Series A picture? What do we need to do, achieve, prove in order to get there? And I sort of hate that, to be honest, because I'd love to just make a bet independently and just say, well, if we can demonstrate that it works, then they will raise funding. But it just doesn't work like that, because things which are not as obvious, like a good example I always give is Fitbit, which is a company we've been involved in since 2008. And Fitbit now is a clear market leader, and they're extremely successful. But in 2010, I really had to work really, really hard to get them their Series A. And I basically sat on the shoulders of the guys from Foundry, and I said, look, if I have any ounce of credibility with you guys, please hear me and spend time with the Fitbit guys to understand why this is such a valuable product and company. And they did. The issue today is there is so much going on in terms of inbound Series A opportunities going to VCs that I don't know that they would spend a couple of months it takes to actually understand that Fitbit is a kick-ass deal in the making. And so for us to figure out what that means, it means longer runways. We typically tell people, hey, we used to say 18 months, now it's 24 months. And when we gather the syndicate of like-minded investors, we try and get deep pockets. And deep pockets at seed stage means 40, 50, $60 million fund that is willing and ready to actually double down and support the company if ever they need what we call now Series Seed Prime, or a bit of a bridge to get to Series A. And so what I'm always concerned about is when you see those deals coming together with just a bunch of angels who don't have those reserves, and basically for whom, the first investment, the first bite is basically the final bite, it could actually, be trouble for the company if they are getting close. But, get the, come back in 6 months kind of answer.
I think we can do maybe 2 more questions.
In the back?
Sure, I'm going to take one of those questions though first. So you are a guy who came to the Valley from far away, but you invest in really 3 locations, right? I mean, you invest largely in the Valley.
So it's
New York.
Yeah, 80% Valley, 10% New York, 5% Boulder, 5% SoCal. We've started to invest more in Canada and the rest in Europe.
Okay, so you do invest all over.
Well, it's very concentrated. So people always ask me, well, do you invest in French startups? And the answer is unfortunately no. And the only thing we do in Europe, I mean, we've done a couple of deals in Europe, so I can't say, no, we don't do deals in Europe, but they're really sort of an exception based on what we think is a unique market opportunity. And the reason why we concentrate so much is that this is actually where we find really good deals, and we don't need to go anywhere else.
Thanks for the lineup. Ben, Bootstrap Lab, Jeff. So following on to the question, I think we hear a lot about globalization and startups starting everywhere in the world. I mean, 500 startups initiatives, gigs on a plane and train and what have you, boats.
Buses.
Yeah, exactly. Very interesting to me to see all those companies getting started and all the governments trying to go after the startup scenes and ecosystems to help solving unemployment crisis right around the world. But the ecosystem is really what makes the difference. I mean, so what do you see those trends shaping up to be? I mean, are we going to see major failures in each country because there are key missing milestones or kind of partners in the ecosystem for the startups to succeed locally? And obviously you're here in Silicon Valley, which is, I believe, very unique, can't be reproduced elsewhere. So any thoughts on that, where that's going to go?
It's a great question, and it's true that we've seen more globalization of entrepreneurship over the past 3-4 years than ever before. The big question for me is, how do you get to scale from the standpoint of the company and scale from the standpoint of the funding? So a good example is, there's a bunch of really successful e-commerce companies in Turkey, and they're getting to scale tens of millions, hundreds of millions of dollars in revenue, GMV, whatever metric you pick. The issue is, what's next? What happens afterwards, and where's the exit? And unfortunately, for most of those companies, the exit is here in the US. And because of that, you see, a few US VCs investing in Turkey, on Europe, and so on and so forth. And there are opportunities, but there's always sort of the big issue of, is there a public market where they can play? And the answer is not clear, except, NASDAQ. And then who's the acquirer? And the acquirer is always someone big here. But, I have no doubt that as Chinese companies, Korean companies become more acquisitive, we could actually see US companies being acquired by those guys. And we've seen that in the gaming market before the gaming market just imploded. So it doesn't mean there's no opportunity. It's just that we at SoftTech have decided to focus on the US opportunity because we think that this is where our network and funnel just gives us the best yield. So it's just a strategy decision.
Okay, so we have one last question, and we always end, at least in my chapter, we always end with this question. So, who's your favorite superhero, and why?
That's not the typical question I get.
Yeah, we're different.
So in 12 years, you're the first one to ask me. Iron Man.
Iron Man?
Yep.
Why?
Because that's what I was reading when I was younger, and I think that Tony is just pretty cool.
Cool. All right, ladies and gentlemen, Jeff Clavier. Thank you.